Why does the IRS or Congress allow IUL to be tax-free? By the end of this video episode, you will understand the 3 sections of the Internal Revenue Code that have protected money from taxes for more than 108 years if you comply with 3 tax citations, TEFRA, DEFRA, and TAMRA. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for more than 48 years. One of my favorite financial vehicles, bar none, that I would recommend that 40 to 60% of your resources at retirement are in for liquidity, safety, and predictable rates of return that are tax-free, so that hopefully 40 to 60% of your retirement income doesn't even show up on the front page of your 1040 tax return. Did you hear that? Yes, this is legal, okay? And I'll explain why it is and why it's been sort of a tax-free cash cow in the Internal Revenue Code for 108 years. So what is one of my favorite instruments? A max-funded indexed universal life insurance policy. Because in the Internal Revenue Code, under 3 sections, it's the only vehicle that I'm aware of that allows you to accumulate your money tax-free. That's under Section 72E. And then you can access your money tax-free. You don't have to wait till you're age 59 and a half to avoid penalties or anything like that. That's under Section 7702. And then at the end of the day, when you finally pass away, anything left in the IUL policy will blossom, increase in value, and transfer income tax-free to your spouse, your kids, your grandkids, your heirs, a church, a charity, whoever you want. I know of nothing else in the Internal Revenue Code that does that. So I've been studying this and helping people as a tax strategist for more than 48 years. And actually, this is what really was the brainchild of E.F. Hutton clear back in 1980. Now, I started in 1974. And so in 1980, Hutton realized, golly, you know, people are putting their money in the market in mutual funds, and our brokers are making money, you know, turning over that portfolio as often as possible. And yet they realized that if you were to earn even 12% in the market, which most people are not, by the way, it's like when I was a kid playing red light, green light. Maybe you might take 20 steps forward and then you take steps back. And they said, well, what if you average 12 positive steps? 12% return, that'd be pretty phenomenal. Well, you're not really netting 12, because if you take 12 steps forward, if you earn 12%, you have to take usually 4 steps back in taxes and or fees. You're only netting 8. And so let's say you had $1 million accumulated at retirement and it's in the market. And if you were earning 12%, that's $120,000 that you theoretically could pull out of your $1 million nest egg, right? But you're not netting 120, you're netting 80,000. And then usually they charge you another 1% in asset management fees, so you're netting 7. The point is, if you earn 12, you're only netting 7 after taxes and fees. E.F. Hutton back in 1980 said, what are we thinking? One of the safest financial industries is the multi-trillion-dollar insurance industry. They're the backbone of America and the backbone of the world. And so they said, golly, in the Internal Revenue Code, these have been sort of protected with tax advantages, because when people take ownership for their own future, if they make sure that if they die, that they won't leave behind widows and orphans that are reliant, dependent on the government, then the government says, oh, in the Internal Revenue Code, let's make money inside of a life insurance policy, grow tax-free. Why do we want to hurt people who are trying to take pressure off of the government? Under Section 7702, what if they need some money if they get laid off or get disabled? Let them access the money tax-free, because otherwise we're going to be shelling out welfare benefits or unemployment benefits or whatever in higher amounts. And so let's just, why shoot ourselves in the foot by taxing people who are trying to be responsible and accountable? And so that's Section 7702. And then when they ultimately do die, if I pass away and I leave behind money to my wife, my children, my grandkids, I'm taking pressure off of the government having to provide for them by me doing that. So this has always actually saved the government money by allowing people to have tax advantage accumulation, access, and transferability. Does that make sense? In fact, anytime that the IRS or Congress, General Accountability Office, the House Ways and Senate and Finance Committees have ever studied this, should we start taxing these? Because they get greedy sometimes. They've always said, leave these alone. Leave these sections of the code alone, because they were smart enough to calculate it would actually cost them more in the long run than it would make them in the short run. And by the way, government doesn't always make smart decisions, but they basically deemed insurance contracts a sacred tax-free cash cow that can accumulate money tax-free. And so a lot of times people just use life insurance for death benefit. So why does Congress and the IRS allow this? Well, because you're taking responsibility and accountability. If you live too long, if you die soon, if you get disabled, you're taking care of your affairs and your family, instead of making your family be reliant on the government. So that's why the government allows this. And that's under these three sections of the code, okay? Now, the other three tax citations, TEFRA, DEFRA, and TAMRA, I explain in other episodes. And by the way, as you are getting educated, if you can think of somebody who ought to hear this, be sure and share or post a comment. We love to hear your comments. But if you're preparing to meet with an IUL specialist, you ought to understand why it's tax-free, how it accumulates tax-free, how you can access it the smart way tax-free, and why it blossoms and transfers tax-free under these three sections. But you have to adhere to the TEFRA and DEFRA tax citations. These are acronyms, so that you take the least amount of insurance, but the required amount of insurance that the IRS says you have to have in order to accommodate the amount of money you want to put into the policy. And TAMRA basically says how fast you can put it in, because some of the other financial institutions, banks, credit unions, brokerage firms, they get jealous. They don't want to kill these because this is where they put some of their money to invest. But they wanted to slow the flow clear back in 1988. So that's the TAMRA. And so when we talk about TEFRA and DEFRA, that requires the minimum death benefit. TAMRA talks about how fast you can fund it. And when we use the metaphor of a bucket, this is the IUL policy, and you structure it so that you can accommodate the amount of money you want to put into that. $500 a month, a lump sum of $100,000, $250,000, $500,000. Maybe you want to sock away $8,000 a month. You can put in lump sums or monthly deposits, but the IRS will make sure you adhere to TEFRA, DEFRA, and TAMRA, and a good IUL advisor will make sure you do that, so that you do not bugger up the tax-free accumulation and the ability to access the money tax-free at the end of the day. Or you don't have to wait till retirement to access money. I've had people put in $200,000 and 4 days later pull out $120,000. It's like a working capital account for their business. So when you look at the advantages, what you're structuring it so that this spigot on the bucket, which is the cost of the insurance, gets smaller as you get older. Wait a minute, have you ever seen an insurance policy that actually gets cheaper as you get older? Well, then you haven't seen one structured correctly or funded properly. That's why it's crucial for you to meet with an advisor who understands what they're doing. So basically, the amount of insurance required is contingent upon your age, your gender, and your health. But don't rule yourself out, even if you have health issues. I had a gentleman that was 78 years old, and he had 3 blocked arteries, adult onset diabetes, a prostate cancer episode, 6 sisters predeceased him, and 3 brothers. And we were able to get him approved for an IUL policy. Now, if you don't get approved, you can use a surrogate, and I explained that on other episodes. But you're designing this policy based upon your age. Let's say you're 60, but it doesn't matter if you're 35. If you're 35 years old and you want to be able to put in $100,000, let's say, over the next 5, 10, 20 years, you can put in monthly or what have you. This amount here dictates the amount of insurance. And so if it was a 60-year-old, it'd be $250,000, about 2.5 times that. Now, you could buy way more life insurance than this for that much money. That's not the objective. You want to take the least amount of insurance, which TEFRA, DEFRA, and TAMRA says this is the least amount for a 60-year-old is approximately 2.5 times this amount. It's an exact number based upon exactly how old you are. But see, as you do this, then your goal is to get the money in as fast as the IRS allows. The fastest they would do it is about 20% a year, maybe about $20,000 a year. But when you do this, now every bit of money that you access out of here can be totally income tax free. It's the most incredible instrument I have ever seen as a financial strategist. In the entire nearly 5 decades, I've been helping people optimize assets and minimize tax. So Section 7702 has been sort of protected since June 21st of 1988. That's the TAMRA. And it wasn't until about December 28th of the year 2020 that Congress finally even loosened up, and you can actually fill up the bucket a little bit faster. You can get away with a little bit less insurance because more and more people are using this for living benefits. So that your 100,000 doubles to 200 and then to 400, then to 800,000. Or like many clients we've had started out with 500,000 and it doubled to $1 million, and then to 2 million, and then 4 million and 8 million. Yup, in 30 years. That's the beauty behind the max funded insurance contract. So Congress, this is not a secret. Sometimes people say, ooh, as soon as the IRS finds this out, they'll close that loophole. No, the IRS is the one that actually dictates how to do it correctly. And it takes pressure off of the government. So what I would recommend as you understand these tax citations and meet with an IUL professional, that you study why this is my favorite vehicle. And you can claim a free copy if you do not have one yet of this book, The Laser Fund. It's over 300 pages of charts, graphs, and explanations, and 62 actual client stories. So go to laserfund.com. You contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that cost if you have not claimed your free copy yet. But here is to your brighter future when you talk to an IUL professional.